Welcome to the Deep Dive. Today we are jumping right into the Q3 2025 earnings call for Collegium Pharmaceutical. Ticker is COLL.
And this really wasn't your standard report. I mean, it was a major signal.
A huge signal, yeah.
Yeah.
It seems like this is their pivot from being just a niche pain management company to something much bigger.
Exactly. A diversified CNS player. And the timing was aggressive. They dropped this pre-market, 8 a.m. Eastern, right after the press release.
You do that when you have good news. You want the market to react, and, well, it definitely did.
Oh, it did. Our mission here is to really unpack what was, at the end of the day, a massive beat and raise.
Okay, let's start there. The immediate impact. The stock closed up. What was it?
13.4%, and on really heavy volume, too.
So let's get into the numbers that drove that. Net product revenue came in at $209.4 million.
Which is 31% year-over-year growth. It just completely blew past what the street was expecting.
Right. Consensus was somewhere around 190 million, I think. So a big beat on the top line.
And it gets even better when you look at how efficiently they made that money.
Of profitability.
Exactly. Adjusted EBITDA hit $133 million. That's up 27%.
Which implies a margin of what, 63, 64%?
About 63.5%, yeah. But the real shockwave, the number that really got people's attention, was the bottom line.
The EPS.
Adjusted EPS of $2.25. It just crushed the consensus, which was $1.88.
Wait, $1.88. So that's almost a 20% surprise.
Nearly 20%. That's a massive beat.
No wonder the stock jumped. We saw it pop, 12% right at the open? And the liquidity.
4 times the normal average. That tells you everything. That's not retail. That is serious cash equity demand saying, we believe this story.
And it's not a one-off thing either. This is a pattern now.
That's the key point. This is the 4th quarter in a row they've beaten EPS estimates. That builds trust. It shows real execution.
It answers the big question investors have had, which is this company a real growth story now? Or is it just managing a decline?
And this quarter screamed growth.
Okay, let's unpack that. Where did the growth come from? The engine has to be Jornay PM, their ADHD drug.
It is 100% Jornay PM record quarter. $41.8 million in net revenue.
Management is calling it their key strategic pillar.
And the numbers back it up. Prescriptions are up 20% year over year. And, they're getting stickier. The prescriber base is expanding.
Up 22% to almost 28,000 prescribers.
They're gaining real loyalty there.
And they made a pretty bold claim, didn't they?
They did. They called Jornay PM the fastest growing ADHD stimulant year to date.
In a market that is notoriously crowded. So what's a differentiator?
It's the dosing.
Yeah.
It's really clever. It's a once daily pill, but you take it in the evening before bed.
So it's working when the patient wakes up.
Exactly. It provides that symptom control right from the get-go, which is a huge deal for adherence, especially with adults. It smooths out the whole day.
And that's showing up in their own research.
Good.
They said it ranks #1 now on differentiation.
Which is a powerful metric to be able to cite.
And it's not just about selling more, right? They're making more on each sale. The gross to net.
Yes, the GTN. This is so important. For anyone listening, that's basically the discount off the list price.
After all the rebates and fees.
Right. And that number improved dramatically. It went from 70% in the first quarter down to 62% in Q3.
That's an 800 basis point improvement. That's huge. What does that tell you?
2 things. 1, they're getting better contracts because they have more scale and leverage. And 2, their returns rates are improving, which probably means patients are staying on the drug longer.
So better profitability per script. And they're guiding the full year number to land in the mid-60s. That's a great sign.
So Jornay is the growth engine. But what's funding it all is the pain portfolio.
And this is where the bears have always focused. They say these opioid cash flows are just going to melt away.
Well, they're not. The pain segment delivered $167.6 million. That's up 11% year over year.
11%. And this is the critical detail, isn't it? It's the 3rd straight quarter that all 3 of their main pain drugs grew.
All 3. Belbuca up 10%, Xtampza up 2%, and Nucynta up a whopping 21%.
That flies in the face of the bear case. Management is basically using this performance as proof that these cash flows are far more durable than people thought.
They're defending their turf really effectively, and they're investing in the data to back it up, presenting a bunch of real-world evidence at conferences.
Okay, but let's dig into that Nucynta number, 21%. That seems almost too good to be true. Was all of that organic?
That's a great question. And no, it wasn't. This is a nuance we have to flag.
Okay.
Management was transparent about it. They called out a $2.8 million rebate settlement benefit in the quarter.
A one-time benefit.
Exactly. They called it a timing difference from the first half of the year.
So if we back out that almost $3 million one-off item, what does the underlying growth look like?
It's a bit softer, for sure. But look, even if you normalize for that, you're still looking at strong high single-digit, maybe low double-digit growth for the segment.
Which for this asset class is still remarkable.
It's still really impressive. The main takeaway is that this portfolio is a cash machine, and it's giving them all the flexibility they need.
And here's where it gets really interesting. Let's talk about where that cash is going. The expense side. Adjusted OPEX jumped 60%.
60, a huge number, but it's all part of the plan.
This is the investment thesis in action.
It is. This was the big commercial push for Jornay PM right before the back-to-school season. They expanded the sales force.
They added 55 reps.
Bringing the total team to 180 people focused just on ADHD.
And they're not just throwing bodies at the problem.
Right.
This is targeted.
Highly targeted. They have a list of about 21,000 high-value prescribers, and that's who this expanded team is focused on. It's a calculated bet.
And it's not just sales reps. The marketing campaigns.
Yeah.
We have to talk about the Paris Hilton collaboration.
I mean, that's a fascinating move. It's not your typical pharma ad.
Not at all. It's designed to hit that adult ADHD demographic using someone who is very open about her own journey.
It's a bold way to cut through the noise. Of course, the risk is when you ramp spending by 60%, you had better get the results.
And so far, based on Q3, it looks like that bet is paying off.
So if you step back, the CEO laid out 3 pillars, right?
Yep.
Drive Jornay growth.
Check.
Maximize pain portfolio durability.
Let's double check.
And 3, strategically deploy capital.
And that's where the story goes from here. Let's talk about that third pillar, starting with the guidance.
Because of the Q3 strength, they just raised everything.
Yeah.
Full year revenue guidance is now $775 to $785 million.
Up from 745 to 760. A nice bump.
And adjusted EBITDA now guided to 460 to 470 million.
And importantly, they also raised the OPEX guidance. They're not taking their foot off the gas. They're confirming they're going to keep investing in Jornay.
Right. But the foundation for all of this, for any future strategy, is the balance sheet.
It's a fortress. They paid down $16 million in debt in Q3.
And ended the quarter with $285.9 million in cash. That's not just safety, that is pure optionality.
Their net leverage is already down to 1.2 times.
Yeah.
And they said they'll be under 1 times by the end of the year.
And they're still buying back stock. They did a $25 million ASR and still have $150 million left on that authorization.
That low leverage is the whole story now, isn't it? It lets them change the narrative.
Completely. It shifts from we're managing these assets to we are on the hunt for a transformative deal.
Okay, let's go there. The business development appetite. This is where that strategic pivot gets very real.
This is the key insight for anyone trying to figure out what's next. Management explicitly said they're willing to lever up to roughly 3 times net debt to EBITDA for the right deal.
3 times. Let's put that in context. With EBITDA running at, say, $465 million, that implies
It implies they could take on over $1 billion in debt for a transaction.
$1 billion+ deal would be completely transformative for a company this size. What are they looking for?
They're being very specific, commercial or late-stage assets, so things that are already making money or are about to.
No early-stage R&D risk.
Exactly. They want immediate accretion, and they're looking in their wheelhouse, pain or CNS.
So this confirms the story. The market is starting to see them not as a company with a melting ice cube, but as a diversified CNS platform.
And that platform is funded by these incredibly durable cash flows. They are ready to do something big. The M&A capacity is real.
Which brings us to our segment, This Is Not Financial Advice, where we take all these facts and spin up a plausible, if outrageous, trade idea.
All right. So what does this all mean? How could you play this? The aggressive trade here is what I call a leveraged BD catalyst long.
A leveraged BD catalyst long. Break that down.
The rationale is pretty straightforward. You've got cash approaching $300 million, leverage is about to go below 1 times, and management has basically put a giant sign on the door that says, willing to spend over $1 billion.
So you go long now in anticipation of a big accretive acquisition.
A big CNS bolt-on, probably in the first half of 2026. The company has momentum, its relative strength rating is in the 90s, they have the money. They have the motive.
And a deal like that would totally rewrite the valuation story, right? It would kill the idea that their revenues are going to flatten out.
Completely. The whole trade hinges on one thing, that management decides to pull the trigger on a big deal instead of just continuing to buy back stock.
And everything they said on the call points to a big deal being the priority.
So to sum it up for you, Collegium delivered a classic beat and raise. It's that simple.
Driven by two things. Jornay PM is a legitimate growth story, maybe even the best in its class. And two, that pain franchise is a much more durable cash cow than anyone thought.
And the whole story now is about capital allocation. How will they use that fortress balance sheet and that willingness to take on leverage to drive the next phase of growth? It's all about M&A now.
This is a platform company, not a legacy products company anymore.
Absolutely.
Okay, we'll leave you with one final thought to chew on. Management raised the OPEX guidance by $10 million, right? Cementing that 60% year-over-year increase in spending.
Right.
So here's the question. Is all of that heavy spending already priced into the new, higher guidance?
Or does that aggressive investment signal that they see even more momentum in Jornay PM? Could there be another surprise coming in 2026 that shocks the market all over again?
Watch the Q4 results and especially their initial 2026 guidance. That's where you'll get the answer.
That's where the bet pays off.
This has been The Deep Dive. Thanks for joining us.